Hello again, this is Mike with NetPicks.com and the Options Mastery Program. So I thought I would take a few minutes, record a video here to walk you through a couple of trades that we have in progress. A couple of unique situations with how we played the trades. Might be a new way for some of you to think about the markets. And the two trades that I want to talk through are energy related here today. So most of us know energy has been very active over the past number of months. Even if you're not trading any crude oil products, if you're filling up your car at the pump, you've seen gas prices all over the place, right? So a lot of times when people see that type of volatility, they tend to shy away from those types of markets. Especially a lot of newer traders, they want to focus on the names that are a little bit more consistent as far as direction goes, a little bit slower, a little bit calmer, less volatile. But when I look at that volatility, I look at it as opportunity. Okay, because there's so many things that we can do in these markets, especially with options, to take advantage of that volatility. So let's walk through a couple of those trades. The first one I want to walk through is on USO. This is an ETF that closely tracks the price of crude oil futures. So if you're not a futures trader, you still want to have some exposure to the price of crude oil, USO is a great product to consider. It's pretty liquid, a lot of activity, especially over the past couple of months. So when we came in back a couple of weeks ago, we took a look at crude oil and we said, all right, look at this move to the downside in USO. Okay, we've seen this big move to the downside. Even if you weren't trading during that stretch, you probably saw the prices at the pump start to really come to the downside, which is great. So when we looked at that chart, instead of reading that chart saying, all right, let's get in, let's try to play the move to the downside, we actually took a contrarian view. We wanted to try to play a bounce higher, saying, in the near term, we're probably a little overdone on USO. So instead of just going in and buying shares of USO or buying a call or a call spread, all of those are valid ways to play the upside. I wanted to take a little bit more conservative play and give myself more ways of being profitable. Meaning, what if I get into a bullish position and the move higher doesn't happen right away? What if we settle into a sideways range? Well, if I buy a call or buy a call spread or even buy shares of USO, I really need that stock to move higher. If it doesn't, I'm going to be in trouble. Okay, so what we did, instead of using those traditional bullish strategies, we actually went in and we sold a put spread. Okay, it's known as a vertical spread. It is, when we're dealing with the puts, I know you're typically programmed to look at the downside, but in this case, because we're selling the put spread to open, it's actually a bullish play on USO. We want it to move to the upside. Now, the reason we went with the put spread, when we collect premium to put a trade on, in this case, we could have made money if USO moved to the upside. Okay, it is a bullish strategy, but because we're selling that premium, we also have the potential to make money if USO goes sideways and potentially if it moves slightly lower. So we could be completely wrong on market direction and still scratch out a profit. Now, some of you might be saying, all right, Mike, that's too good to be true. Well, let's take a look at what we did here. Let's go over to the trade page. This is Thinkorswim. Okay, you can do this type of a strategy in any broker platform out there. Okay, so this is the trade page on USO. We went out into October. We went out into the monthly options and we wanted to sell a put spread. So what we did here is we went out and we sold to open the October 14 and a half, 13 and a half put spread. Okay, so let me go ahead and get those strike prices in there. All right, so what that entails there is we're selling the October 14 and a half put and we're buying the 13 and a half put to make it a fully hedged position. A lot of times people are intimidated by these strategies initially because they think, hey, I'm selling premium, I've got massive risk there. I've got assignment risk in there. Well, this is a fully hedged position. Okay, yes, we're selling an option, but we're also buying an option at the same time. So when we put this trade on, we originally sold it for 38 cents. Okay, that 38 cents, that's the most we can make on the trade, or $38 per spread, because every option here represents 100 shares of stock. Okay, so when I collect that 38 cents, okay, and you can actually still put this trade on. It's actually still trading for 39 cents. So let me hit confirm and send here. Let me show you what I'm talking about. So our maximum profit is whatever we collect for the trade to put the trade on. Okay, in this case, it's actually $39. Our maximum risk, the most we can lose on the trade, remember it's a fully hedged position, the most I can lose is the difference between the two strikes here. You notice there's a dollar wide difference between those strikes, and we're going to subtract the credit that we receive for putting the trade on. Okay, which is going to give us a risk of 61 bucks. So originally you look at that and say, okay, Mike, you're risking $61 to make $39. I really don't like that reward to risk ratio. Well, remember what I said a few moments ago. Okay, we can potentially make money if the market moves up, down, or sideways. Okay, so how is that possible? Well, look at our break-even point. It's 14.11. That's calculated by taking our short strike, the 14.5 put. We're going to subtract the credit that we received, putting our break-even point at 14.11. We make money on this trade as long as USO is above 14.11 by October expiration. Okay, so I don't care if USO goes to the moon. If it zooms to the upside, that's great, perfect. If it stays sideways, if we get into a dead sideways move here, that's fine. As long as it's above 14.11, I make money. Notice USO is currently trading for right around 14.45, just below 14.50. So we could actually have USO move slightly to the downside. As long as it's above 14.11, I still make money. Okay, I'm going to throw in a few additional kickers here. I make money if volatility contracts. One of the reasons we put this trade on is because we felt volatility was higher than normal. Okay, so if volatility contracts, we make money that way as well. We make money from time decay. If you buy a call or buy a call spread, you guys know that time decay is working against you. The clock is ticking as soon as you put that trade on, and you need it to move in your favor quickly. Okay, when we sell a put spread, the time decay is actually working in our favor. We're collecting premium each day that we hold the trade. So now we're giving ourselves 5 potential ways of booking a profit. Again, buying shares of stock, buying a call spread, you only make money in one potential market move, one scenario if it moves higher. By selling the put spread, we have 5 ways of being profitable. So even though it doesn't look like we have a great reward to risk ratio here, I actually love this trade because we have so many different ways. We don't have to be perfect on market direction or our outlook on volatility or timing. Okay, we don't have to be perfect because we're selling that premium. So let's quickly go back over to that chart a second. Since we put the trade on, we initially saw the bounce higher and we were into a little bit of a profit right away. Okay, oil has since pulled back and now we're kind of settling into a little bit of a range here. So I was bullish on USO. Had I bought the call, I'd probably be in trouble at this point. The time decay is hurting me. We haven't seen the move higher. I'd probably be underwater. Because I sold the put spread, I've been dead wrong so far on my bullish outlook. And I'm down a penny, right around unchanged, right around break even. Okay, that's the power in selling premium. Okay, let's take a look at one more real quick. Let's take a look at XLE. This is another energy ETF. Very similar outlook to USO. This isn't as highly correlated to the futures market like USO is, but it's going to follow oil prices over time. So when I look at this chart, I said, holy cow, we've seen a big move to the downside. We got into this stretch over here and we said, all right, instead of jumping on board a short trade here and trying to play the move to the downside, it's already a little extended. We already missed most of that move, so I don't want to chase it. So let's take a contrarian view and say, all right, what if XLE bounces here? What if it moves to the upside? What can I do to catch that move? Well, very similar to USO. I could buy shares of stock, I could buy a call spread, but because we saw this move to the downside, volatility increased, so I looked at selling a put spread. I felt that options were a little expensive, so let's go ahead and sell the put spread. Let's give ourselves multiple ways of being profitable. So what we did here on XLE, we took a very similar approach. Let me pull up the trade page. We stayed in October options and we went ahead and we sold the 63.62 put spread. Switch these strikes around, 63.62. And we originally sold this trade for 40 cents. Okay, it's now trading for 53 cents. So some of you might be saying, all right, Mike, why are you showing me a trade that's losing? Okay, well, let's think about this here in detail. When I originally talked about putting this trade on, when I put the trade on, Okay, I had a bullish outlook. I wanted XLE to move to the upside. I've been dead wrong on market direction. Had I bought a call or bought a call spread, I'm facing a large loss. Okay, because I sold the put spread, I've got time on my side. I can afford to hold this trade longer because the time decay is working in my favor. Okay, so I'm able to offset some of the directional move against me, and I'm able to hold on to see if it reverses and moves back to the upside. So if I were to go ahead and let's just say we're putting this trade on now for 52 cents, okay, to calculate your maximum risk, you take the difference between the strikes, which is $1, you subtract your credit that you received, and you're looking at about $48 of risk. So initially, I know people, they shy away from selling options to open up positions, but you don't have to be scared of those positions when they're hedged. When you turn them into a spread, it's actually a very safe position. Okay, so now when I sell this put spread to open up the trade, again, do I want XLE to move to the upside? Yes. Okay, can I make money if we settle into a little bit of a range? Yes. Okay, as long as I close back up above my break-even point. And that break-even point is calculated by taking your short strike, the 63 put, and we're going to subtract whatever credit you receive for putting on the trade. So I collected 40 cents. Okay, my break-even price on this is 62.60. Okay, so we're a little bit below my break-even point. Well, there's no reason to panic here because I have 22 days left before expiration. All I need to have happen here is I need XLE to rally up about 60 cents over the next 20 days, and I'm going to book a really nice profit. Okay, so that's why I love these trades. You don't have to be perfect on picking market direction, and you're still able to book profits. Okay, so I'm trying to present to you a different way of approaching the markets. Okay, a lot of times retail traders focus in on strategies that, yeah, they have home run potential, but they have very little chance of success. Okay, instead of taking those long shot trades, let's go ahead and put some odds in our favor. Let's go ahead and sell some premium, take advantage of the volatility, and I think you'll be amazed at what you see. In our Options Mastery program, we've sold quite a bit of premium. Okay, in the month of September, we won on 80% of our short premium trades. Okay, and in many of those, we were wrong on market direction. Okay, so expand your playbook a little bit, and you're definitely going to be able to smoothen out your overall equity curve over time. Instead of being frustrated, not seeing the results that you're looking for, change it up a little bit. Okay, try some different strategies, and I think you'll be impressed with what you see. So we'll check in on these trades here as we head into next week. We'll continue to track them. These are both trades that I have on, many of my Options Mastery students have on. So we'll be able to track them live, and we'll keep you posted on what eventually happens with these as we get closer to October expiration. So hope you're enjoying the volatility. I'll be back over the next couple days with the next video.